Incoming transmission standby. Welcome to the Nod News Network. According to researchers at the Bank of Canada, economic sanctions have hurt both Moscow and the West, but they are beneficial for neutral parties. In a recent research paper, economists at the Bank of Canada argued that nations can gain from declining to accept Western sanctions against Russia. Experts compared the effects of sanctions on Russia, the US, EU, and UK as well as on major third-party economies like China, India, and Turkey in a report published last week titled International Economic Sanctions and Third Country Effects. The calculations were based on three different sorts of sanctions: limitations on exports and imports, restrictions on the banking system, and energy embargoes. Analysts predict that sanctions would slow Russia's economic growth, but the extent to which they have an impact will depend on whether non-Western nations join Western powers in enforcing restrictions. Researchers predicted that Russia's GDP would decrease by around 4% in comparison to a fictitious scenario without restrictions if sanctions were simultaneously imposed by the West. However, they asserted that Russia's GDP would decrease by 9% if other nations adopted similar policies. The researchers also predicted that sanctions would result in a 0.8% decline in the economy of the penalizing nations. However, if other nations continue to stay out of the sanctions battle, this effect would quadruple. The researchers asserted that because of substitution effects, third country economies should gain from avoiding sanctions. Restrictions on Russia provide them a chance to act as substitute suppliers and to replace Russian goods on the marketplaces of the sanctioned states. The GDPs of these nations would eventually increase by an estimated 0.4% as a result. The report, according to analysts surveyed by the RBK news site, emphasizes the value of the country's trading relationships with China, India, and Turkey. Experts also pointed out that the calculations did not account for Russia's import substitution and parallel imports processes, which were crucial in enabling the Russian economy to recover from its 2.1% GDP decline last year. By the end of 2023, the Russian economy is anticipated to grow by 2.5%, according to Finance Minister Anton Siluanov's forecast made in late August. The World Bank, the IMF, and Barclays Bank recently increased their projections for Russia's GDP amid strong trade and industrial production as well as higher than expected energy income, adding to the positive view provided by Western experts for the nation. This has been the Nod News Network, transmission complete.